Hi class, welcome to Business 20 Introduction to Business. In today's lecture, we'll be going over accounting and financial information. Our learning objectives are explain the function of the income statement and balance sheet, evaluate company's performance using financial statements and ratio analysis. The role of accounting. Accounting is the process of measuring and summarizing business activities, interpreting financial information, and communicating the results to management and other decision makers such as owners and other stakeholders. Accounting is often called the language of business because it communicates information that owners, managers, and investors need to evaluate a company's financial performance. It helps stakeholders make better business decisions by providing them with financial information. Fields of accounting. Management accounting helps you keep your business running, while financial accounting tells the outside world how well you're running your business. So what is management accountant? It is also known as managerial accountant, which plays a key role in helping managers carry out their responsibilities. The information that is provided is intended for use by people who perform a wide variety of jobs. The format of reporting information is flexible. The reports are tailored to the individual needs of managers, and the purpose of such reports is to supply relevant, accurate, and timely information that will aid managers in making decisions. When preparing, analyzing, or communicating this information, accountants work with individuals from all the function areas of an organization, such as the human resource, operations, and marketing. Financial accountants furnish information to individuals and groups both inside and outside the organization in order to help them assess its financial performance. Now let's look more. Into financial accountants. Financial accounting is responsible for preparing the organization financial statements, which include the income statement, statement of owner's equity, balance sheet, and statement of cash flows, which summarize a company's past performance and evaluate its current financial condition. If a company is traded publicly on a stock market, these financial statements must be made public. Fundamental accounting principles. Let's look into generally accepted accounting principles, also known as GAAP, which refers to a set of standardized guidelines, procedures, and rules that govern financial accounting practices in the United States. These principles ensure consistency, comparability, and the transparency in financial reporting, enabling stakeholders to make informed decisions. Some examples of GAAP principles include the matching principle, revenue recognition principle, and the principle of conservatism. Accrual versus cash basis accounting. Records revenues. Accrual basis accounting records revenues and expenses when they are earned or accrued, regardless of when cash is exchanged. This method provides a more accurate representation of a company's financial position and performance. Cash basis accounting records revenues and expenses only when cash is received or paid. While simpler, this method may not accurately reflect the timing of economic events and can distort financial results. The matching principle dictates the expenses should be recognized in the same period as the revenue they help generate. This ensures that financial statements reflect the true costs associated with generating revenue. An example of this is if the company sells a product in January, but it includes the related expenses in February, the expenses should be recorded in January to match them with the revenue from the sale. Revenue recognition principle is the revenue recognition principle dictates the revenue should be recognized when it is earned, regardless of when the cash is received. Revenue is considered earned when goods are delivered or services are rendered, and the customer is obligated to pay. This principle ensures that the revenue is reported in the period in which it is earned, providing a more accurate depiction of a company's performance. So, in the next few slides, we're going to be looking more into the financial statements, such as the accounting equations, balance sheets, income statements, and break-even analysis. So the accounting equation. So the accounting equation is assets equals liabilities plus owner's equity. The accounting equation is a fundamental concept in accounting that represents the relationship between a company's assets, liability, and equity. It serves as the basis for double entering bookkeeping, ensuring that transactions are recorded accurately. The importance of the accounting equation, serves as a foundation for the double entry accounting system, ensuring that every transaction has a dual effect on the company's financial position. It provides a framework for analyzing and interpreting financial statements, helping stakeholders understand how assets are financed and claims against those assets. So what are assets? They are things that are owned by a person or business that has value, such as land, jewelry, gold, equipment, and cars. Your liabilities are things that you owe or have borrowed. Examples are loans, accounts payable, mortgages, deferred revenues, bonds, warranties, and accrued expenses. Owner's equity is the investment in the business. Examples of equity are capital, such as the common stock or retained earnings. The income statement. The income statement, also known as earnings statement or profit and loss statement, reports the profitability of a business or organization for a stated period of time. In accounting, we must measure profitability for a period such as a month or a year by comparing the revenues earned with the expenses incurred to produce these revenues. First, financial statement prepare, as you will need the information from the statement for the remaining of the statements. So the income statements include revenues or sales, your expenses, such as cost of goods sold, the total cost of the goods that you've sold, operating expenses, which are the cost of operating your business, except for the cost of the things you've sold. Then you get the gross profit or gross margin, which is the formula for that is sales revenue minus the cost of goods sold. Then the net income or profit is the gross profit minus the operating expenses. So here you have, here's an example of an income statement. You have your sales. Then from your sales, you subtract cost of goods sold. That gives you your gross profit. From your gross profit, you subtract any operating expenses. here in this income statement, we're giving the salaries, advertising, and tables rentals, which is a total of 300, and your net income is a total of 100. Statement of retained earnings or owner's equity. A statement of retained earnings, which is sometimes called a statement of changes in equity, shows the sum of the earnings that a company has accumulated and kept in the business since it started operations. A retained earnings ending balance for an accounting period is equal to the retained earnings at the beginning of that period, plus net income earned during the period, minus dividends issued to state shareholders during the period. In some cases, a company's financial statement does not include a separate statement of retained earnings. The information is typically included in the income statement or balance sheet, or as an addendum to one of those documents. Balance sheet. A balance sheet is like a photograph that captures the financial position of a company at a particular moment in time. The other two statements are for a period of time. As you learn about the assets, liabilities, and stakeholders' equity contained in a balance sheet, you will understand why this financial statement provides information about the solvency of the business. So the balance sheet reports the following: assets, such as your cash, your liabilities, which is the debt, the debt that it owes to outside individuals or organizations, and then the owner's equity, the investment in the business. Statement of cash flows. Report on the cash receipts and cash disbursements of an entity during an accounting period. Cash includes both cash and cash equivalents, such as short-term investments in treasury bills, commercial paper, such as promissory notes, certificates of deposit, and money market funds. Let's look into the break-even analysis. Break-even point is reached when total revenue equals total cost. Below this point, the company is losing money. Above this point, the company is making a profit. Fixed costs are the costs that do not change with the level of production or sales. An example of this are rents, salaries, and insurance. And variable costs are the costs that vary with the level of production or sales. Examples of these are raw materials and direct labor. Total cost is the sum of fixed cost and variable cost. And the total revenue is the money a company earns from selling its products or services. So how do financial statements connect? How do the financial statements connect? The financial statements show interconnectivity by 1. The balance sheet shows us assets, liabilities, and owner's equity. The details of the changes of the owner's equity section of the balance sheet can be found in the statement of owner's equity. Now, in the statement of owner's equity is net income. Net income is the profit or the loss the company has generated during the year. The details of the net income are shown on the income statement. In the income statement's bottom line is the same net income or loss shown on the statement of owner's equity. That's all for today's lecture. Thank you so much for watching.